This is a recording of problem 5-1A, so it's a long example that has some purchases and some sales on it. All right, so in this example, we're talking about Kearns Books. So Kearns Books both distributes books to retail bookstores, so this means it sells them. And when it sells them, it gives credit terms of 210 net 30 to all its customers. These are transactions during June. And Kearns Books also purchases books. So our first transaction, we have a purchase of books. So we are the buyer. When we purchase these, we have FOB destination, and the terms we're purchasing under are 210 net 30. That means that they are purchased using credit, because they wouldn't give us terms if it wasn't purchased on credit. The appropriate party. So we have to figure out who the appropriate party pays cash for the freight. So FOB destination. So if there is FOB destination, freight on board destination. So the ownership transfers when the freight or the free on board when the product reaches the destination. So the seller owns the product until it reaches our dock, because we're the buyer. So we don't own it until it gets to our shipping dock. That means that the seller will be responsible for the freight. So this means, because it's FOB destination, that the seller is going to pay the freight. So the seller pays the freight. So we don't care about the fact that the seller paid the $50 for the freight. So we're going to ignore that. So this purchase, we're going to debit our inventory because we're using perpetual method, and we're going to credit our accounts payable. So that would be the entry to record this. We need to make a note that our terms are 210 net 30, because when this is paid, we have to look at that. All right, our second transaction. So in this case, we're the seller. So we're selling to our customer. So this is selling books to our customer. So Reading Rainbow is our customer. So the sales price is $2,500, and the cost, so the cost of goods sold, will be $1,440. Now, it says up in the beginning of the problem, our terms are always going to be 210 net 30. So we just need to keep track of that, 210 net 30. So whenever we have a sale, there's two steps. So the two transactions, we've got one is the sale and two is the cost of goods sold. So your sale should always be larger than your cost. Because our terms are 210 net 30, and that was told to us at the beginning of the problem, this is going to have an accounts receivable, and that's for the sale amount of the sale, and we have sales revenue of $2,500. The cost of the sale, so the sales revenue means we have to have a cost of the sale. So the cost of the sale is $1,440, and that is going to reduce the amount of inventory we have. All right, next transaction on 6/6, we're receiving a credit for books returned to Binsfield. So in this case, we're receiving a credit. Binsfield was the seller, and you might have to go back and look. These are books that we purchased, so books we returned. So we were the purchaser. So when we return these, we're going to reverse. So they're coming out of inventory and it's coming out of accounts payable. So accounts payable is being decreased. And inventory is being decreased. Okay, so it's important that we understand which direction these are going. So Binsfield is our supplier. Binsfield was the seller. We were the buyer. So you need to make sure you remember who we are. We were the buyer. All right. Now we're going to pay Binsfield in full less the discount. So in order to do this, we have to figure out how much was in accounts payable. So when we bought these, we had terms of 210 net 30. The original purchase was on June 1st. So the first thing we have to do is check this date. So we're on 6/9. The original purchase was 6/1. So we're still within the 10-day window. So we can take our discount. We started with 1,600. We returned 100. So the current accounts payable is 1,500. We're going to figure out what the 2% discount is. So 2% of 1,500 is $30. So step 1, we're going to reduce accounts payable and reduce inventory because we have to show in inventory how much we paid. Actually, you're going to pay for the inventory because the rule is inventory needs to reflect the cost that we paid for inventory. So we're reducing the amount we owe and the value of the inventory. So inventory reflects what we're going to pay. And after we've corrected the value of the inventory and the amount that we owe, because we're going to be paying within the discount period, then we'll show that we're paying accounts payable of $1,470, which is that $15,000 balance, minus the $30 discount, giving us an ending balance of $1,470, and then we're going to pay it. All right, number 5. So on the 15th, we're going to receive our payment from Reading Rainbow. So remember, back on June 3rd, we sold books to Reading Rainbow. So we were seller. Okay, and Reading Rainbow is our customer. So we have an accounts receivable from Reading Rainbow. So 615, we have to look at that, is 6.3 plus 10 would bring us to 613. We're currently at 615, so that means they're past the 10 days. So they do not get to take a discount. So we expect to be paid the full amount. So the original sale was $2,500. So that's what we need to collect. So the original sale was $2,500, so that's what we expect to collect, $2,500, and it's a decrease to the accounts receivable for $2,500. All right, so transaction number 6. On 6/17, we're selling books on account to Wrap Books, so we are the seller. And Wrap Books is our customer. The cost of the books was $10,080, and this would be the sales price. So we have 2 steps. we got to do the sale, and then we got to do the cost of goods sold. Okay, so pretty straightforward. Accounts receivable and sales revenue, cost of goods sold, and inventory. The sales revenue should be greater than the cost of the goods sold because you want to make money on this. Okay, number 7, we're purchasing books on account. So we are the buyer. Okay, so we are the buyer. So we're getting inventory and we owe the money. And we're buying it from, again, we have FOB destination. So that means when the seller ships it to us, we get ownership when it arrives. So the appropriate party makes a cash payment of $60 for the freight on this date. So the seller owns it until we receive it. So that means the seller pays for the freight. So pretty much we don't care how much the seller paid for this because, well, we wouldn't even know how much the seller pays for it. So we're not interested in this. And our terms are going to be $215 net 30. So we're going to need to know that when it's time for us to pay for this. So inventory goes up 1,800 and we have an obligation to pay or accounts payable for 1,800. All right, on the 8th, we're going to receive payment in full from MRAP. So this originally, the sale took place on the 17th. We gave terms of 210 net 30. So 617 plus 10 gives us till 627. And we're at 624. So we're within the discount terms. So they're going to get their 2% discount. So 1,800 times 2% is $36. So we record a sales discount, which is going to decrease our accounts receivable. So we have a sales discount gets a debit, accounts receivable gets decreased. And the amount of cash we're going to collect is the amount 1,800 minus the 36, so 1,764, and that goes against accounts receivable. On the 26th, we're going to pay McGinn in full, less their discount. So we purchased on the 20th $18,000 of product, and our terms were $215 net 30. So on the 20th, we had 15 days terms. So 6/20th plus 15 days, that would be 6/30/35, which isn't a real date. So that would be 7/5. So this due date was July 5th. And our payment was July 26th, so we're within the discount terms. So we get to take this 2% discount, so 1,800 times 2% is $36. So accounts payable is decreased. And because this is inventory, inventory is recorded at the amount that we actually pay for it. So it's debiting accounts payable, crediting inventory. So accounts payable shows what we owe, and inventory is going to show what we pay for it. And then we're going to show accounts payable at what we're paying for. So it's the $18,000 minus the discount amount, or $1,764, and the actual cash payment. For number 10, on 6/28, we're selling books to Bateen. So we're the seller. And Bateen is our customer. So the customer is going to owe us a receivable, okay, because we have a sale and we will have a cost of the sale. So your cost should be lower than your sales. So our accounts receivable, and we give terms of 210 net 30, and that's the terms we give to all our customers. So we have accounts receivable of 1600, sales revenue of 1600, and then we have cost of goods sold and a credit to inventory of 970. And then on 630, we're going to give Bateen Books a $120 credit for books that are returned. And the value of the books returned is $72. So we have sales returns and allowances, which will reduce the amount that's owed to us. So you have a debit to sales returns and allowance because we don't want to go directly against sales because we want to keep track of that different information, and the amount they owe us is now lower. And we're putting those books that were returned back into inventory and reducing that cost of goods. So this is just a straight across flip, and this one we're not flipping it directly against sales, but we are just reducing the accounts receivable. And that is the last slide, so that's all there is to it.